Building further on our knowledge of cost behaviour, this lecture introduces the cost-volume-profit model. As its name implies, this model deploys the relation between cost, the cost driver or activity level, and calculates their impact on profit. The model gives us a powerful tool to quickly evaluate the probable impact on profit of different decisions. This is often referred to as a what-if analysis. So those are the key concepts that we'll be covering in the next few slides. So first of all, what is this cost, volume, profit analysis? It's a simple series of calculations that you can put together and then manipulate so that you can answer all sorts of short-term questions about changing a variable and seeing what the impact of that change might be. And so here are just 4 of the possibilities, which are almost limitless. First question, should we change the selling price? But presumably you might want to do that to see if you could make a greater profit. How many units of product or service must we sell in order to break even? Break even in this context is defined as being a profit of 0 and therefore no profit, no loss. Most of us want to make a lot more than 0 profit, and so the next question then, how many units of our product or service must we sell to reach a target profit level? Much more realistic, that one. And another one, how much should we spend on advertising, given that we would expect the impact of advertising to be positive, presumably on our sales level. Okay, now there are 2 key measures that we need to cover off in our discussion of this cost volume profit model, and they are these. The first is a contribution margin, which is a very useful concept. It's calculated as sales revenue less variable costs, and it can be calculated at the level of the sale of a single unit of product, or it can be calculated at the level of selling many dozens or hundreds or however many items of product is relevant for your discussion. The point here is that when you say the selling price minus the variable costs, what's left is the contribution margin, and the job of that contribution margin is then to cover the fixed costs, and anything which is then left over will be profit. The second concept here is the break-even point. Now, as I've already said, the break-even point is where there is no profit and no loss, or you could put it into an equation, as you will see we will do in a few minutes, and that will be an equation where profit is defined as equaling $0. We can express the break-even point in either units to be sold or required dollars of sales revenue. So there's a key assumption that sits underneath the cost volume profit analysis, and it is this. It is that sales revenue is assumed to behave in a linear fashion. And so what that means in practical terms for you and me is that larger volumes of sales to perhaps a very good client would not attract a discount. Sales behave in a linear fashion, and if you think back, this is a parallel assumption to the ones that we made when we were looking at cost behaviour, and we plotted the cost function as being a linear function, where we also assumed that that linear relationship remained true. And when we're talking about sales revenue in this environment, we assume only one independent variable, and that is the volume of sales. The volume of sales is what drives the sales dollar. Here's an example. Going to calculate profit. Okay, and we're going to put that into that simple equation which is there in blue. That profit equals the sales revenues minus all of the costs. And costs here are fixed costs and variable costs. You'll notice in the CVP model that costs are always spoken about in terms of their behaviour, that's to say either fixed or variable, We don't talk about costs in terms of some of the other cost terminology that we explored in the previous presentation. And so in order to calculate the profit, simply put it into the equation. Here we've got some information. The selling price is $10 per unit. The variable costs are $6 per unit. The fixed costs are a total of $40,000. And so when it goes into the equation, P for profit is equal to $10 times the volume, which is X, and minus then all of the costs, which is the fixed costs, $40,000, and variable costs, $6, again times whatever the sales volume is, represented here by X. Here's another example. Here's how you would calculate the break-even volume in units, recalling that what underlies this discussion is that a break-even profit equals $0. And so you can put the answer in there, as you can see. Profit, P, and on the second line there is equal to 0. So P equals selling price, $10, times the volume. And volume is what we're solving for in this equation, minus all of the costs, the same costs again, fixed costs, $40,000, variable costs, $6 times X. And when we play with the algebra, which I'm sure you can do, and if you can't, you're probably going to have to go back and revise that, we get to 4x equaling $40,000, and therefore X, the break-even in units, is 10,000 units. And if you want to prove that to yourself, then put that 10,000 into the equation instead of X and multiply it out, and what you will come up with is a profit of 0 based on selling 10,000 units and based on the cost structure which we have in front of us. That's to say 40,000 of fixed and variable costs of $6 per unit. Another question that we're likely to ask of this CVP model: how many units must we sell to earn $20,000 of profit? Now, in the previous example, example 2, we asked how many units in order to break even. And break even, as we know, is $0 of profit. Here the question is $20,000 of profit. How many units must we sell? And so we put it into the same equation, but instead of profit being $0, now profit is $20,000. So when it goes to the same equation, and this time the answer is that X equals 15,000 units to be sold in order to generate a $20,000 profit. Just a point of warning here, notice that this is all done in pre-tax dollars and sales levels. The profit there of $20,000 is pre-tax, it's not after tax. Here's an example of the fourth question. What should the selling price be in order to make a profit of $10,000 on sales of 10,000 units? So we're locking in the volume that we're going to sell, and we're setting a desirable profit of $10,000, and we're saying, okay, given those two requirements, what would be the selling price which would achieve that outcome? Again, note that the cost structure remains unchanged. And so again, put it into the same equation, except that this time P for profit equals $10,000. And using 10,000 units for sale, 10,000 times S, the selling price. Now in this example, we are solving for S. Minus the total costs, again, 40,000 are fixed, and the 60,000 is calculated by taking the variable cost per unit, which is $6, and multiplying it by 10,000 units for sale. So when we solve for S, we get S selling price must equal $11. Margin of safety.